Where should you park your emergency fund? You should not park your emergency fund in the regular bank account, which is connected to your regular ATM, which you use for groceries, for everything. No, it has to be a separate bank account. Okay. Maybe you can invest it if you want your money to grow, but invest it in such a way where it can be encashed in a very, very short time. It should not be invested in some kind of a big time mutual fund where it is stuck for 3 years or 4 years or 5 years. Should not be invested in a 3 year GIC, which is giving a good rate of return, but now the money is locked in for 3 years and you have the emergency on Saturday morning. You need the money Saturday morning. You can put it in a bond fund or some kind of a growth fund or a 1 day renewable kind of a deposit, whatever it is. That money should be easily accessible. Okay. But also that doesn't mean that that money should be sitting in your closet where anybody and everybody and becomes too tempting for you and for you because you look at it every day. Okay. Oh my God, the $5,000 sitting in image. Oh, I'll replace it tomorrow. It doesn't. It doesn't work like flashable GICs. Credit card is not your emergency fund. This is what I said in the beginning. A 5,000 or $10,000 credit card, unused credit card is not your emergency fund. It's a liability fund. Like building a house, you must build it from the ground up. Your foundation should be strong. So when you're building a house and you're talking about funds, your investment is the most important thing which you need to build up from the ground up. So where do you get the money to invest? Most people, where do they get the money to invest? From your income. And that is what we spoke about in the workshop number 3. That you have to, first of all, secure the source of your income. You don't have any income, you cannot manage your debts. You don't have any income, you cannot save for emergency fund. And you don't have money or recurring money, cannot build up your investment. So the foundation always is the protection, and which leads us to the other platform. So we're going to talk about investment and growing your wealth. Money making money. Everybody loves that word. Money making money. So why do we invest? We work so hard all our lives hoping that we become financially independent. We build up our wealth in hopes to, most people, the important thing is to buy a house or, retire sooner or become financially retired. You don't have to give up work, but to become financially retired where you don't have to worry about tomorrow's bills. The day you don't have to worry about your bills, you are financially retired. Okay. And how can you do that? Because the day know that, let's say you're, hypothetically speaking, your monthly regular expenses are $10,000. So the day you know that your business or your source of income is going to generate $10,000 for you, whether you get out of bed or not, is the day you can say that I'm financially retired. You don't have to be physically retired. You can still go to work. Okay. I think Mark Zuckerberg, he's what? He's 35. You think he can be physically retired? I don't think so. He's still got a long way to go. Financially, yeah, pretty much retired. Billions of dollars of sitting in his assets. So even if he doesn't go to work, his bills will be paid. Control our time. Bring us your goals and whether we'll work on our strategy. This is our aim to help you. We don't say that we can make money for you. Can't make your money grow as you want. But definitely, if you bring your goals together to us, we can help you design a good plan whereby you can start saving money and become financially stable in the next few years. Okay? So our life cycle, very simple. The first phase of our life cycle is the accumulation phase. Everybody can relate to this. From the time you graduate from your high school or college, you've been accumulating assets, isn't it? Buying things, accumulation, buying thing, accumulating, saving money, getting the paycheck, saving into the investment, whatever you do, that's all the accumulation phase. Once the accumulation phase is over, we call it the distribution phase. While we are accumulating, in fact, we are also in the distribution phase, not distribution. Distribution in simple language is the spending phase. And how long do we spend? Close to about 40, 45, 50 years. We keep on spending. So we got to be making money. We got to be accumulating in those 50 years. Otherwise, our accumulation is going to fall below zero. So we keep on accumulating and we keep on distributing, we keep on spending. Then comes the final stage, which is the state transfer. This is the last stage of most people's lives. This is the stage when people stop working and people start conserving some of the accumulation that they have done all their lives so that they can pass it on to their next generation as a legacy. That's the state plan. Everybody's life goes through these phases. I can't give you exact numbers when you do this, but people have their own plans. Most people will live longer. That's one of the best news. How many people enjoy this news? Because the medical industry is rapidly doing so many great things that the longevity is definitely there. If people, I remember 20, 30 years ago, the average age of most senior citizens used to be 65 to 70. Then it went up to 75. Today, the average age of a Canadian is about 83, 84 years old. That's a good news for many people. We all live longer. Everybody wants to live longer. On an average, Canadians' life expectancy at age 65 today can expect to live until the age 83 and a half for men and age 86 and a half for women. Women are always the winners. Okay? 86 and a half. But you know what? The bad news? Most people are not saving enough for their retirement. So most people, when do they mentally get retired? 65. 65 people start thinking that I'm pretty much retired. Okay. I'm downhill. I'm not going to work anymore. So 65 to 86, how long is the journey? 21 years. Now tell me something. In those 21 years, what is the most essential thing that you need? Money every day. If you don't have money, you don't get breakfast. You don't have money, you don't get lunch. You don't have money, and you don't have a roof over your head. You don't have money, you cannot buy new clothes. You don't have money, you cannot even make your kids and grandkids happy. So money is the most important thing. So if your lifestyle needs, let's say, $5,000, I don't know what will happen when I retire because I'll be retiring after 20 years. Things will become more expensive. Let's say I need $5,000. Then if I live for 20 years, how much should I have accumulated? 20 years times 5,000. Can somebody do the math for me? So if I don't have that kind of accumulation, I should not feel comfortable, isn't it? That's all I'm trying to say. So over the past few decades, pensions have dramatically declined. We all know that. In fact, the companies have changed their philosophies about pension. If the company pensions can no longer be relied upon and government benefits may not be enough for one's desired retirement, which I can vouch for that. Okay, I've did some calculation in the last couple of years from the CPP how much I can get. I was devastated. I said, no, don't even talk about it. Consumer must be responsible for their own financial security, and that is what we call the three-legged stool. First of all, our life is very precarious. It is depending on three legs. Three-legged stool is not very stable. You should have four or five legs. But out of those three legs, number one is that personal savings. And if you look at most people's personal savings, it is actually on the decline for the last 10 years. Then there is another leg on that stool which really helped our parents and grandparents, company pensions. Nowadays, most companies have changed their philosophy about company pensions. This is the kind of company pension that they are offering: defined payment, defined contribution. Many years ago, it used to be defined benefit. That means your benefit was exactly written down. This is exactly what you get when you retire. Today, that wording has changed. Today is defined contribution. That means this is what you will contribute to build your retirement. What you'll get is in the hands of the big one. So what you would depend on for retirement from most to least, okay, you got to figure out. Now you tell me, out of these three legs, which of the ones that you think can be the most stable for you? or which is more in your control?
Personal savings.
So saving. You cannot rely on the government. They have to take care of 40 million people. You cannot rely on the companies. They can change the rules anytime they want for their own benefit. The only thing that which is under your control is your personal saving. So we're going to talk about the personal saving part. So let's focus on that. Remember when I started the meeting, I said at age 25, nobody thinks about retirement, but life can be so easy if we can educate somebody at the age of 25. So our goal is to have $1 million saved up by the time we hit 65, which I think everybody has that goal in their mind, the back of them. Whether they say it or not, everybody has that goal. Here are some of the numbers which will amaze you. If you're age 25 and you have about 40 years left to hit that retirement age, all you got to do is put aside $284 per month, invest it wisely in a fund which is giving an average of 8% return, which is not exceptionally high or exceptionally low, and your goal would be $1 million. Is that good? Now, do you think 284 is doable number? If you put your mind to it, you can do it. Most people pay their even at young age 25, most people pay more than this for their car or even for their what do you call the driving car insurance. Okay, especially the young boys I know. The girls are a little cheaper. For the young boys who are less than 25, they generally end up paying about 300, $400 a month. $400. So let's say somebody misses the boat at age 25, nobody talked to them, they reach to the age of 35, and they still want to have that dream of $1 million. See, the whole numbers change now. Age 35, you start the same campaign of $1 million at the age of 65, the numbers jump up to 666. That's a huge difference. That's a huge difference. Literally what? More than double? It's not a happy feeling. So our mission has become more and more important now because there are many, many, many people in this country or in USA who are in this particular age group from age 25 to 35. All we need to do is bring them here or take this workshop to them and give them this education. That if you can save $284 a month, you will most probably end up a millionaire, unlike many of the family members that you see every day. Well, as time goes by, people don't act on it. And generally speaking, people don't act on it because they think two things. Number one, at age 25, nobody gives them the education. At age 35, they have other responsibilities. They get married, have kids, and a house, and a first mortgage, and two car loans, and lots of things. I'm going to start saving later. And when they say this, I'm going to start saving later, that means they're going to start at the age of 45. Fortunately, the number literally jumps up to a huge number. Anyone here who's 45? I have to do 1686 every month if I want to wrap it up in 20 years. But you know what happens? And we deal with, and I'm sure some of the people who are licensed here, they will know. We deal with a lot of people who are age 45. And this number is far away from their minds. What are they thinking about right now? They're thinking about buying a new carpet for the house, buying new curtains and drapes or new rugs and decorations and stuff. They're not thinking about retirement because at age 45, retirement seems like a very far away dream. So, as what I'm trying to say is that as time flies by, the cost of building up that security literally jumps up severely. And when somebody's at the age of 55, it jumps up to about more than $5,000 a month, which probably for many people in North America is a dream which they can't even dream about. So, regardless of whether you have time, you can always leverage the market. So, how do you leverage the market? The calculator is given here on the screen. If you want to take a picture of that, you can do that. And this calculator will actually tell you and give you a determination of how much money you need to put aside based upon whatever your age is right now. May I change? Please go ahead quickly. One of the best calculators. I used it many times with my clients. So, rule of 72 is a very simple formula. Rule of 72 simply tells us that, and we have studied this before. Rule of 72 tells you that If you divide, if you divide the number 72 with the rate of return that you're getting on your deposits, on your investment, the resulting answer is how many years it'll take your money to close to double. It's a very simple formula. Let's say they give you a formula. If your money is growing at 6% and 72 divided by 6 means what? You can see 12. So every 12 years, as you can see on the screen, every 12 years, your money is doubling. Doubles from 10,000 to 20,000, from 20,000 to 40,000, 40,000 to 80,000. If you can change the rate of return, this is what we are trying to tell, that if you can change the rate of return from 6% to 7%, okay, your doubling time reduces from 12 years to 10 years. In that same time span, you can see that money actually, if because it is doubling faster, end result at the age of 36 is literally different from column 1 to column 3. In column 1, your end result is about $80,000. In column 3, your end result is over $300,000. So would you like to know how to get a better rate of return on your money? Because it can change your destiny. Okay? So saving for retirement, what are the different avenues where you can save for retirement? You can save for retirement in your RSP, which is the most common one, and most people talk about it. You can also save your money in the government pensions. You can save your money in savings account. Unfortunately, many people are led to the savings account where there's no rate of return. You can save your money in insurance policies, which is a whole life policy, pension, annuity, stocks, bond, universal life. Now, how many people really understand these products? Most people have no idea about the functionality of these products. How much do you know about it? Before you even understand these products, you got to understand how the markets work. There is the equity market, the mutual fund market, there are ETFs and exchange funds. I'm not going to go into too much detail, but I hope that you take some time out to learn about these markets and sit with the person who invited you here today. Okay. So if you're already one of our associates, definitely sit with your SMD. Your SMD will be able to help you go through these understandings, basic understandings. So what are we here for? We're here to help you understand the strategies. Some things might seem hot at the moment, which a couple of years ago, a few years ago, the real estate market was very hot, and people put in the life savings and sometimes not even life savings, even they borrowed future life savings into that with the hope that something will happen. Today, they're going through a crisis. So, as I explained before, what did I say before? Many people follow the good trails of what happened yesterday. And one of the biggest disclaimer in the financial industry, we always tell people that the numbers that you see yesterday are definitely no reflection of what will happen tomorrow. You cannot literally say that, hey, this market is giving us 10%, so you can rest assured it's going to give you 10% for the rest of your life. It may or may not, I don't know. You can't actually project based on that. So, as you can see, the market history, this is just a ballpark figure, market history. Markets have a tendency to come down and go up, come down and go up. It is always there. It has always been there for the last 100 years. And it's not going to change. And there are some fundamental reasons why it happens. Okay? It's called profit taking. There are some smart investors, there are some average investors. Smart investors always encash their profits. And average investors keep on hoping that it will go up permanently all their life. Never happens. Never, never, never happens. Okay? So, as you can see, but one of the remarkable things that you must understand from this graph is that, and this is a graph from since 1955, which is close to about 70 years now. In 70 years, every 5, 6, 7, 8 years, there's huge market growth, and there then comes a huge correction. I call it correction. It's a correction. It's a correction because when do markets come down? When a lot of smart investors start selling their products and take their profits. And that's when the market starts coming down. For it, I'll give it to you in a very simple language. If in Mississauga Road today, there are 100 people who start selling their houses, what is the general phenomena with most people? Oh my God, they're all selling, they're going away. So that means there's something wrong with this road. Let me sell mine too. And they start selling. And when people start selling, can you actually demand your price? No. It's called, what do you call it? A buyer's market. That's when the market starts coming down. But then again, there are people sitting on the sideline who have got money in their pocket. They're called investors. I'm waiting for opportunities like that. And when the market does correct itself, it does come down, the investors come up and they start buying things at cheaper prices. Isn't it? Like when the 2025 models are introduced in the month of September, many people go and buy the 2024 model because the guys have to clear it out, start getting it at a cheaper price. So people have to be smart about when they invest, how they invest. Should I understand history or get swept away with sensational news headlines? Unfortunately, the social media gives sensational headlines. Education, WFG, WSP. Okay? Look at what has happened in the most recently. Looking at the beginning of 2020, how would you feel? We look at the graph on 2020, literally very down. Okay? March of 2019 was one of the lowest. Will you respond to emotion? If you are an emotional buyer, would you buy at 2020? At the point of 2020? Most emotional buyers would not buy it. Oh no, the market has gone down. Very simple example. Today is Saturday. Today, if Walmart announces that everything is rolled back, everything is at 20% discount, what would you do? Right. You would go and buy a 1 year supply of toilet paper. It's a discount. But unfortunately, when it comes to the personal investment, think the reverse. Oh my God, this particular share market or particular price or this asset is coming down in price, so maybe I should stay away from it. I'll buy it when it becomes more expensive. Unfortunately, because of lack of education. That's the only thing. It's a lack of education. Potential portfolio investment losses, very simple to understand, but very difficult to manage. When you have a 10% loss, 10% gain will not put you in the same place where you're before. You need 11% gain. When you have a 40% loss, which we had in March of 2020, 40% loss in the stock market, to get back up, we needed a 67% gain just to get back to the same place. When you have a 100% loss, 50% loss, you need a 100% gain to get back to the original place. Very simple. If you have $100 and you get a 50% loss, how much have you lost? 50? Guys, okay. So what do you have with you now in your hand? $50. If you want to go back to 100, do you think a 50% gain would take you to 100? No, it's going to take you to 75. You need a 100% gain. Okay. So these are some of the things that people need to understand. Unfortunately, many people look at just the traditional numbers, don't look at the downsides. So have you experienced a market crash in your lifetime? Anyone here? I have many times. So dollar cost average, best safety tools. Dollar cost averaging is an investment strategy in which invested across a periodic purchases with the goal of reducing impact of volatility on the overall purchase. And what do you mean by this? If you have $100 to invest, if you spread it over 12 months, how much are you investing every month? About $8. So the first month, you will be investing $8. You will get your stocks or units or shares at a certain price. Next month, you invest another $8. The price of those stocks or units will be higher or lower. It can change. And they keep on changing. But if you keep on doing this, in simple words, what you're doing is you're averaging the purchase. That's all. So this is called dollar price of that particular product was very high, maybe $100 at that point in time. So you get 1 unit because you've already purchased in February, March, April, May, June. But if something happens, the market doesn't go up and the cost of that unit comes down, your value of that asset goes down. Okay. So dollar cost averaging is a very, very simple strategy to conserve your purchasing power of the dollar. Here's a very simple example I've given you. Let's say you start out investing with $20 a month. Okay. Sorry, no, $100 a month. Okay. And the first month, the price of the units were $20. How many units will you get? Five. Second month, you invest $100. The market has come down. The cost of the units are now $10 each. From 20, it's crashed down to 20. Remember, you're a smart investor. What do? You keep on investing. You get 10 units. Month, it comes down again to $5. Fourth month, it comes down to $2. So you get more and more units. When it comes to $2, how many units do you get? 50 units. Now tell me something. If you're a smart guy, what do you think will happen to this product if the price of the phone comes down from $100 to $2, $20? Do you think phones are going to become extinct? No. A lot of investors are waiting on the sideline, start buying at that point. And that's when they start buying. And when there's a demand for a specific product, prices are always increased by the sellers. This is exactly what happens in the stock market every day of the year. When the price goes up to 10, you again invest your $100 and you get 10 more units. How much have you totally invested? $500 in 5 months. How many units have you got? 95. Let's say you sell all those 95 units at this point of time, even though the market is lower. You started buying at 20. Okay, now it is at 10. If you sell all your 95 units at this price, how much will you get? How much did you invest? Was the market rising or falling? So in a falling market, because you use dollar cost averaging, you still come out a winner. You got that? And this is the same fundamental we use in our insurance policies. We keep on paying month after month after month after month for many years. You're getting the best dollar cost averaging that you can ever get from the value of that small premium that we pay. But how long do we pay for our policies? Maybe 20, 30, 40 years. With dollar cost averaging for 40 years, you get the highs and the lows every month. And that's how you build up your huge portfolio in the insurance plans. Okay, so let's move forward. Now, the second safety net that we always tell people is diversification. Diversification very simply means that do not put all your eggs in one basket. Your basket drops, your eggs break. You have a scrambled egg. But if you have 4 or 5 different baskets, one of the baskets can drop, you get scrambled eggs, but the other 4 baskets still carry the whole eggs. So diversification is spread your money into various industries, various portfolios, and various investment vehicles. Okay, various companies. So what works for you? Where diversification meets risk tolerance is very, very important. Asset allocation is very important for you. It's a Nobel Prize winning investment strategy that aims to balance risk and reward by adjusting a portfolio's assets according to an individual's appetite for risk and goal. Most important thing is the risk tolerance. Most people have high dreams. Most people want to double their money. Most people want to quadruple the money. But when you remember, when you want to double your money, when you want to quadruple your money, there's always a chance that your investment can go bad too. How many people have got the stomach to bear quadrupling their losses? Very few. So we've got to understand, as financial educators, we've got to understand the risk profile of each and every person before we recommend them some kind of an investment. Properly licensed financial professional can help determine which allocation is best suited for your needs. Okay? As life changes, Our allocation needs also change. Our dreams also change. Our risk appetite also change. In the early years, we can probably go into a lot of equity based growth, equity based market, because we have the ability to take the risk. We can absorb that risk and still survive. But as we grow older, we want to have move our portfolio towards a little bit more conservative, little bit more balanced kind of a fund, simply because we are not mentally ready anymore to take those shocks. We don't want to see those shocks. Okay? Rebalancing is something that the investment companies do on your behalf, or you can do it yourself. Rebalancing very simply means that if your taste, if your appetite says that I'm going to keep 25% of my money in equities and 75% in some kind of a balance fund or growth fund or something like that, you automatically keep on changing those funds, or the investment managers will keep do that for you depending on where you invest. Okay, they'll maintain that same ratio for you over and over again. Be sure to periodically reevaluate your investment goals and risk tolerance, and this is how you keep on making changes. If you want to do a risk profile test for yourself, on the screen again, the risk profile sheet, read those questions. And if you read those questions, honestly, those questions will help you understand your risk appetite yourself. Everybody got it? That's very simple. Scan me, it says scan me. A simple assessment questionnaire can be used to help determine the type of investor you are so that you can select the proper mix of investments consistent with your financial situation and risk tolerance. It's very, very important to understand where you are today, where you want to be in the next 5 years or 10 years or 20 years, and what kind of risk are you willing to absorb during those 20 years. Okay, the risk profile determines all. Find out your investment risk type, take the questionnaire now. Okay, you can screenshot that and take the questionnaire. So, some of the questions that we should be asking ourselves: how can I improve on what I have? Most people have got something or the other in terms of assets. How can you improve on that? Okay? And people may be at a starting point. That's okay. They have a different kinds of assets. What strategies am I currently implementing to help achieve my goals? These are questions that one should ask themselves. How tolerant am I to risk? Some people are born very risk shy. They don't want to take any risk. Some people are very adventurous. They say, okay, fine, I'm young and I can take any kind of risk right now, and I'll become more cautious later on when I'm 35 or 45. Okay. Knowledge is power. We believe that knowledge is very, very important. It's power, but it's even more powerful for an educated investor to use your education and properly manage your whatever assets you have. Okay. So I'm just going to show you a testimonial of one of our potential persons who actually had a very good experience with us. Her name is Miss Wada. I finally reached it. This is her statement. I finally reached my goal of creating a 6+ month of emergency fund. So obviously, it tells us that before she came into our organization, before she came into the workshop, she had no idea about emergency fund. She was probably carrying a gold card in her pocket. Okay? It was hard in the beginning, but with consistency, it got easier. Anyone can do it. Since I have these backup funds, I was not worried or stressed when COVID-19 hit. When somebody relate to the COVID-19, beginning of COVID-19, what was the biggest challenge to most people? If I'm not going to work, how am I going to pay my mortgage? Isn't it? Most people had the same question asked to me. And my answer was different. I became unemployed, but thanks to WSB, I didn't have to touch those funds. Okay, emergency fund came around. Only you can take these steps. Nobody else can push you. Only you today, after this workshop, you can take the steps for which are necessary to change your future. One of the greatest miracles is that you can change your life simply by changing the way you think. You don't have to be born rich. You don't have to be rich. You just have to start thinking differently from where you are today. Okay. So, as a homework, before I close the show, as a homework, I would definitely want you, number one, I would want you to sit down with the person who invited you here today. Sit down with the person and see how you can build up your investment portfolio, how you can build up your emergency. Number two, you must go out there and share this opportunity with as many people out there. Remember, there are millions of people out there who have never been exposed to this kind of financial education. And that's our job, our mission to help those people. And number three, we must make sure that next Saturday, 11 o'clock or 10 to 11, we should be here to look at the next workshop that we're talking about. Okay. Our next workshop will be uh, fulfilling long term goals. Okay. So, building savings and wealth. Building savings and wealth. That will be our next one. Next Saturday, 11 o'clock, same time, same place. Oh, Tuesday, I'm going to repeat the same workshop again. Okay. So, in case if you feel that somebody could have been here, is not here, or you probably need to hear about all of these things again, Tuesday, 7 p.m., we'll be doing the same workshop again. Invite your friends and family, do invite yourself. Okay. So thank you very much. I hope that this information was good for you and you'll be able to. Okay.
Can you announce that? We have a form inside in the guest for the guest.
Oh, okay.
Yeah. Uh, Hello. Thank you very much, Palavar. Wonderful job. I just have to share. I have to tell you that if you can go to the chat, you can see the form, information form, the feedback form. Please, can you fill it up and submit? It will be received to the person who invited you in this workshop. We need your feedback. So if you can, please submit that form. Okay. Can you see that in the chat? Let me show you in the chat. Yes. If you can see the chat, there's a form, Google form. Please fill it up right now before you leave if you're a guest here. And we appreciate your feedback and information, which is we want to we can invite you also ourselves for the special sessions and we need your feedback. Thank you very much, everybody. Give a great, is it not a great job from Dilawar Zahidi?
Yeah.
All right, great. So our fourth workshop, my one of the favorite workshops, because we discuss about investment and these two calculators, which is I posted in the group. If you guys seen that already, this calculators is also always amazed me that we can do we can do that lot wonders we can save we can make money at our platform and we can save money too at our platform, okay, through our platform, and we can build wealth. This is amazing journey so far I had. My name is Andalit Masood. If you are a guest here, I'm in this company past 20 years. I'm the CEO marketing director of this company too, and we had a great business built up together. We have 900 plus licensed agent right now in our team, and we are going on a very faster rate. We've brought a lot of successful, that people that in there in Canada and North America, they came with us and they built our business together. So if you are a guest, we can fill up the form that you can give them a form that cards for people. Who is a guest here? If I can ask you, please. Can you give them finance one card and pen? How many one? Your name, sir? Angar? Angar. Angar. Okay. So yes, can you give them both of them form and pen so then they can give us a feedback card. And you too, Bhupinder, to your guest as well? Okay, good. First time. First time. So first time. So can you please give them a cards and give them a yeah, go ahead. You can please help them. Okay, go ahead. And please fill up the card and give to the person who invited you here today. All right? And any question you have, you can write down the question at the end too. You can flip the card. You can see over there, there's a appointment time, next meeting time with the person who invited you, or the person who is actually senior of them. They can help you to guide you and give you the answers of your questions. And that's how that you can please attend our next workshop. Did you learn something from this workshop? Wonderful. What is your background? Finance and accounting. Who invited you here? Oh, Fazan. Okay, all right. Finance and accounting. So you must enjoyed it, right, today? All right. Wonderful. So yeah, did you enjoy it? Okay. What is your background? Business and IT. Did you learn something new? You liked it? Do you think that you can now save and invest with the program, right? For your future? Wonderful. Bhupinder, how you like it? That's good information, great information. Wonderful. May I know that your background as well? You work somewhere or not? Great. Good to see you here. So we are all welcome, okay? And if you are in that our Zoom room, if you are still here and you're a guest, please introduce yourself. If it's not that you left already, thank you very much for the guest. I have to let you know we have the next session we are starting now. Our next session is that for maybe 30 to 40 minutes. We want to talk to our team members, our